Well, I'd like to welcome everyone to Axiom Valuation's webinar this afternoon and this morning in certain places. COVID-19 market meltdown. Is your institution prepared? Implications for credit loss and loan impairment. John Roberts, I'm a managing director at Axiom Valuation, and we'll have two presenters today. The first presenter is Dr. Stan Feldman, who is the co-founder and chief valuation officer at Axiom. And then the second presenter is John Byrne, who's a managing director and is a CPA and an ABV. Axiom Valuation Solutions is a nationally recognized financial security and business valuation firm. We have offices in Massachusetts and Arizona. And I'd just like to do a little housekeeping for this presentation. It should last about 30 minutes, and at the end we'll take questions and answers. If you have a question, at the bottom of your Zoom screen, there's a Q&A button that you can click on and type your question in there. And then at the end of the presentation, we'll go through the questions that people have come up with and answer those questions. And also, we will be sending an email to all the attendees with a copy of the PowerPoint presentation and a link to recording of this webinar. And you should get that in a couple days. So with that, I'd like to introduce Stan Feldman. Stan, take it away.
Thank you very much, John. And thank you all attendees for making the time today to attend. The two important points we want to make, or the areas we want to cover, is the current state of the credit markets and implications for loan default, whether they're bank loans or syndicated loans, and then how best to apply fair value metrics to account for loan impairment and for credit quality markdowns. Now, this is not news to all of you, but we're in the midst of likely the largest economic downturn since the Great Depression. It may not be of the same duration, certainly won't be, but certainly the magnitude of the decline is equivalent to what happened in the Great Depression. The implications are numerous, but one in particular is that default rates are likely to be in double-digit rates, which is far in excess of what our recent historical experience has been. So let's kind of go through as to what the basic underlying factors are that we at Axiom are looking at. The first thing to keep in mind is that industrial production in February, late February, March, declined by about 5%. This is the largest decline in industrial production in the post-World War II period. Industrial production is an important leading indicator for GDP. And the implications, of course, for unemployment. Now, the way to think about the unemployment rate, as we all know, is the unemployment rate goes up during recessions and down during expansions. The unemployment rate during the 2008 crisis reached about 10%. We expect that the unemployment rate during this downturn will probably, be in certainly the double digits and in the neighborhood of 20%. Now, how do we get to that? Well, we already have about 26 million people collecting unemployment benefits. So we already up to that, the max of what we thought when the presentation was put together several weeks ago. But if you look at the numbers now, there's 26 million people are collecting unemployment benefits, likely to be 30 or more, which implies unemployment rates in the neighborhood of 15 to 20%. So if we do the basic arithmetic, and you said, well, what's GDP per employee, for an example, or per person in the civilian labor force? It's about 131,000 per person. If you multiply that number by 30 million, you get a huge decline in GDP. Now, the offset for that, of course, is the stimulus, and therefore not all of that economic throughput is going to be removed. Some of it, people will spend money, obviously, and the stimulus will help fund some of that. But you have to keep in mind about the nature of the stimulus. For example, the $1,200 per person, which is the checks that are being written for people making below a certain level of income, family income. That's kind of transitory income. And we know that the marginal propensity to consume at a transitory income is about half of what it is of the traditional income. The result of this being is that the economic impact of the stimulus program will be far less stimulating, if you will, than people expect. And the result of that will be is a significant downturn in the economy as a result of the COVID-19. Now, one of the things to keep in mind is that the decline in GDP we have in the first quarter, we have it at 0%. It actually came in today at close to 5%. And so what does that mean? It means that that March was a very, very bad month, and it offset any gains in January and February. We think the second quarter is going to be down by about 7.25%. Same thing in the third quarter, and by the fourth quarter, it'll be down by 5%. So if you kind of if the numbers that have been reported today, kind of, even though we missed the first quarter, we were actually too optimistic. They are actually tracking, if you think about this, the numbers we're expecting in the 3 quarters of 2020. So GDP is way down, and the implications for profits, of course, is also very negative. So if you look at the profit ratio, that is the percent of profits as a percent of GDP, you can see through this chart that during recessions, this ratio declines and then recovers, and it may also decline as you approach the next downturn. In this particular case, it has declined from a peak of close to 12%, 12%, and we expect it to be actually down by about 5% as we move through 2020, which gives us a decline of 38% in the ratio. So when I combine the declines in the ratio in profits with the decline in GDP, we get a huge decline in before-tax corporate profits in the neighborhood from the beginning of 2020 to the end of about 60%. My guess is that that's not being factored into the economy, into the stock market or the credit markets at the moment, and for reasons that we'll cite. The reaction for all of this, of course, is that the amount of cash cushion available to companies to support principal repayment and debt and interest payments is now significantly less, and this is an important point. And the reason why spreads began to widen in the first quarter of 2020. All right. Now, this is a high yield index option adjusted spread and produced by the Fed. You can see that in the latter or the beginning of the first quarter of 2020, spreads rose and they were in a double digit levels. And since then, in the latter part of, spreads went up. They kind of peaked in the middle of March, and now have come down significantly. And they've come down significantly for a couple of reasons, none of which is related to credit risk specifically, or I should say is less related to credit risk and more related to liquidity. So in the case of spreads declining, two things are happening. The least important, of course, is the stimulus program. There's a certain sense of optimism that people have as it relates to the stimulus program, how it's going to work, and how firms are going to eventually have sufficient cash to pay back principal and interest. But the predominant reason for spreads declining has to do with liquidity. The Fed has gone way out of its way to tell everybody, and I'm sure Mr. Powell will tell people today in his press conference, that they're ready to buy debt from medium-sized and large companies, corporate debt, which would be, it's not the first time they've done this. They did a little of this in 2008, but this will be a much bigger deal this time around. That's what's driven spreads down, that essentially the Fed's creating a market for some of this debt, and the debt will be held by the Fed. Now, the interesting part of this is bad debt, regardless of who owns it. And if it defaults on the balance sheet of banks or alternative lenders, or it defaults on the balance sheet of the Fed, it's still a default. And so the default rates are not going to change, but who actually owns the debt may actually change. In fact, I'm guessing it will. So spreads have increased. Most of that spread increase has, spreads have declined from their peak. Most of that decline has nothing to do with credit risk per se. It simply has to do with a lot of liquidity. If I look at fallen angels, for an example, if I look at the spreads there, those spreads are actually declining through 2019, and Moody's was expecting an increase in spreads in 2020. Now, in fairness to Moody's, this particular chart was produced at the end of 2019, before COVID-19 was it was on the radar screen, I think, but not in the kind of magnitude that it is now. And I'm almost certain that Moody's, in fact, I know that Moody's have changed its view with regard to spreads in terms of to the extent that spreads reflect credit risk as opposed to liquidity. Our view, of course, is that spreads will increase from where they are now as the economic downturn results in higher default rates. Now, the other thing to keep in mind is that we'll get to default rates in a moment, is that part of the recovery, if you will, when a loan defaults, not repriced, but when a loan defaults, there are a number of ways in which the principal can get paid. Presumably, if there's collateral there, the collateral will get sold, and there's some recovery to the principal that was owed. Now, traditionally, bank loans have had high recovery rates, and the reason they've had high recovery rates is because the debt stack is built up from publicly traded bonds, or just bonds generally, and then where bank loans are first lien at the top of the debt stack. So in a bankruptcy, they get paid first. But after 2008, the debt structure, particularly for private firms, has changed dramatically. First, private firms don't have access to the public market, to the public bond market, at least not easily. Second is that both public and private firms are depending more on loans. The loans coming not necessarily from banks post 2008, but from alternative lenders. Business development companies, for an example, is just one example, but there are others as well. CDO kind of entities have also bought bank loans. The point here is that when the debt stack is predominantly loans, the recovery rates for loans are likely to be far lower. So let me give you an example. Moody's has reported that companies that defaulted in 2019 that had both bonds and loans on their that made up their debt stack, that the recovery rate for those companies that were issuing bank loans was in the neighborhood and defaulted was in the neighborhood of 74%. In 2019, for companies that were predominantly bank loans, which is most private companies, the recovery rates were closer to 50. They were about 52%, closer to 50%. So the tremendous difference between what the recovery rate is depending on what the debt stack looks like. The result of all of this is that default rates are likely to be far higher this time around. Now, here's a chart of what the default rate looks like. Default rates look like, and they have the cyclical nature as you would expect, namely defaults go up during recessions. Those are the kind of the blue lines that you see, and defaults go down during recoveries. Sometimes defaults occur earlier than a recession, as was the case, for example, in 2019. Default rates actually did go up. In any case, but in 2020, we're looking at default rates that are closer to 19%. This would be the highest default rate since the Depression. And the probability of this happening is very high, it seems to me. It's about 60% in our analysis. And what does this default rate represent? So let's be very, very clear. This default rate, first of all, the default rates that you see historically are actual default rates. So they're actual, so it's basically defaults divided by the number of securities that are outstanding. In 2020, and these default rates are referred to in the literature as actual default rates, but they're really cumulative default rates. That is, default rates, it's just simply a counting of defaults by cohort. So the 18.8 or 19% default rate is really a cumulative default rate. There's a large number of companies that are below investment grade, triple B minus on the S&P scale. And if you go down to the lower end of that, B, for example, and B minus, the default rate in that cohort or in that risk category is going to be very, very much higher. So the default rates are going to be much higher. Now, whether in fact the Fed buys the debt or not, these companies will default. Or at a minimum, they'll be repriced if they enter into bankruptcy. Now, given all of this, the question for banks, it seems to us, is, well, how do I handle all of this? Like, what do I do and how do I prepare for it? Now, this is not to suggest that banks or any kind of lender is not prepared to do this, but we have a set of tools that we think are very useful, and I'd like to review those with you. And there's something called the Axiom credit platform, and the credit platform itself is designed as an efficient, cost-effective way to identify what I will call cracks in credit quality. We can use the credit platform to develop synthetic credit ratings, which we've done for the last 10 years. We can also look at a specific loan or pools of loans. So let me just show you and go through two elements of this. The credit platform starts with something called the credit model, which is up at the top. The credit model is a lot of statistical analysis that's related to factors that drive credit ratings and defaults. And so kind of we use that model as a major driver. And then on the left-hand side of this diagram, we have what we call a competitive analysis block, covenant testing block, and if we go here, what the enterprise value to debt coverage looks like. We do a lot of this analysis. Now, a lot of this covenant analysis and competitive analysis for public companies is pretty straightforward, but for private companies, it's not. And that's why the credit platform is so powerful, because we have a number of databases that allow us to do this kind of analysis in a very, very effective way. So when I combine the credit model with the other factors, we get a credit rating. We get a credit rating, and then we get a credit spread. All right. Think of the credit spread as an option adjusted spread. The years to maturity, depending on the debt instrument. We develop a discount rate, which down at the bottom, we do a number of things to adjust for liquidity, and we finally get what we call a final fair value. So the model can be used for fair valuing securities, and we've used that historically for that. It also can be used, as we'll show later, for credit loss assessment as well, because it's very powerful. People have, over the years, the big four accounting firms, for example, have asked us, well, what drives this black box, the statistical model the statistical analysis that you're doing is part of what I'll call the credit model. Specifically, what they needed to know, of course, is backup. you guys making up the numbers, or is it actually something you've actually done? And so we produced a set of papers which a number of the larger accounting firms have access to, have had access to. And those papers have been also distributed at one time or another to the SEC for review. So it's not something that is just something that is excuse me, is new. It's a credit model that's been in existence for a very long time, and the basic fundamental variables that drive it are unlevered beta, debt to equity, revenue, which is it's a proxy for size, and the cash flow to revenue ratio. Excuse me. The relative strength shows the relative strength of the various variables, where beta is actually the strongest variable. And basically what it says is that in the fixed income marketplace, whether it's loans, bonds, or any other fixed income instrument, what we find, of course, is that whatever the riskiness is in the equity markets, the fixed income markets are looking at it and using it as an input into assessing credit risk. Another way of saying this is kind of like the Merton view of the world, where equity markets tell us something about the debt markets. The other question, of course, that often comes up here is, are there only 4 variables? Well, the answer is no. There are a lot more than 4 variables. But the reality for all of this, S&P, Moody's, the rest, if you took all the variables that everybody looks at and you put them into some sort of clustering form, that is a cluster of by type, what you'd find is that they cluster into the variables that we're showing here, the 4 variables that we're showing here. This is to say that various elements of the income statement are correlated with each other, and the elements of a balance sheet are correlated with each other. So the question is that if all these variables are correlated, you want to choose the ones that are producing incremental information as it relates to credit risk and indirectly to default. Now, spending one more moment on this, the question always comes up is to, you can go to the next slide, John, thank you. Question always comes up, how accurate is this model? First of all, we've worked with this for a decade. So this is not, like I said, not something new. One way to do this, and there's a paper which down at the bottom, you can read the paper. It's much more detailed than what I have here. But basically what this is showing is that the errors associated with using our credit model are very, very small. And the error assessment that we're doing is not some sort of econometric regression error, but it's really an out-of-sample forecasting or projection analysis. But you can see that most of the errors are between 5. If you go up to the top of this chart, the number 51 is the number of securities that we were looking at, and the pricing error is somewhere between -5% and 0, which is actually quite good. If you compare us to the S&P, for an example, using pricing as the metric of success, S&P does very, very well. Moody's, I haven't done Moody's, but Moody's would equally do well. We've done marginally better, which means that our system is quite accurate in terms of estimating credit quality, both from a family perspective, that is the family credit rating, as well as individual loans. Well, now, after saying all this, I'd like to turn over the presentation to John Byrne. And John will take you through a number of cases that will show you how the credit model is used, not only to fair value bank loans or syndicated loans or any fixed income instrument, but how to account for potential credit loss for a loan or a portfolio of loans. So John, you're on.
Okay, thanks, Dan. So I can tell by our snooze meter that most of you are still awake. Good job.
Yeah.
So let's take a look and see how the current environment is affecting credit losses in your loan portfolio. Here we have an example of the potential magnitude of credit loss that could occur based on what we're seeing in the markets through mid-April. This example compares the credit rating at 12/31/19 for a hypothetical company operating in the retail, apparel, and footwear industry, a sector that has been hit hard by COVID-19. Remember, the drop in industrial production causes a cascade effect on GDP, profits, and free cash flows, which in turn affects credit spreads or market yield on debt. The four key variables Stan presented earlier are on the top portion of the slide. We are forecasting a deterioration of all four based on current and forecast economic conditions. Under this scenario, the synthetic credit rating drops from a BB to a B-, with a significant increase in the cost of debt and a drop in fair value of almost $5 million, or 22%. That's pretty dramatic. So, how does the Axiom credit platform fit within GAAP? This flowchart is the legacy GAAP framework for reporting credit loss. That is, for those reporting entities who are not yet subject to the new CECL credit loss standards. For loans held for sale, there's no change in the accounting standards. Both pre and post CECL are carried at the low of cost or fair value. For loans held for investment, legacy GAAP uses what's known as the incurred loss model. And under that model, you have to meet a probable loss threshold before recording a loss. Probable meaning likely to occur. This is one of the reasons why CECL is being implemented, because in many instances, that probable threshold was not met, and yet there was deterioration, which eventually caused loss recognition in subsequent periods. So gradually, we see the FASB is pushing more financial instruments to be recorded at fair value. Under legacy GAAP, using the incurred loss model, you first identify non-performing loans and measure impairment under three methods. You can estimate the present value of expected cash flows, discounted at the effective interest rate. You can use observable market prices or the fair value of the underlying collateral. Our platform, in effect, creates a shadow market price using a synthetic credit rating based on the four key variables we discussed earlier. We believe the shadow market price is a proxy for secondary market price. Now, for all other loans not individually assessed for impairment, you create pools based on similar risk characteristics and estimate the credit loss based on historical experience and current trends. That's the legacy GAAP model for reporting entities who are adopting CECL in 2023. Well, similar to the impairment of individual loans, we can use the same approach for our loan pool, applying the four key variables across the entire pool. Again, a synthetic credit rating is generated for each pool based on the risk characteristics. Embedded into that credit rating is the default probability and recovery rate. The credit loss for these loan pools will be critical for those of you on this call who have business loans to companies who are deeply affected by COVID-19. Under legacy GAAP, it is highly likely the probability threshold is met at your measurement date. But the loans may still be performing for a period of time. So technically, it's not in default, but for how long? That's the big question. Using our platform, you can create loan pools and apply the forecasted variables to evaluate potential credit loss, just as we did in the previous example. This is the flowchart for entities who are subject to the new CECL standards. The first major difference is that there is no probability threshold that must be met before a credit loss is recognized. In fact, at day one, a provision for credit loss is recorded, and for every reporting period thereafter. The second major difference is that instead of identifying individual loans for impairment on an asset-by-asset basis and then creating loan pools for the remaining portfolio, that process is reversed. Under the new standard, only if a loan doesn't share similar risk characteristics with other loans would you then evaluate for credit loss on an individual basis. Again, the major difference in the new CECL standards and legacy GAAP is the recognition threshold. Under legacy GAAP, once the threshold is reached, the credit loss measurement is the same under both pre and post CECL standards. Next slide, please. This is taken from the Financial Accounting Manual for Federal Reserve Banks, offering guidance on the legacy gap model and loss contingencies. You will notice there's a specific reference to the expected loss, which is exactly how our platform works, using credit spreads that incorporate loss rates and default probabilities. This is really what a lot of banks will be struggling with right now, the loss contingency from COVID-19, which has potential for default across a wide spectrum based on the social distancing and forced shutdown of businesses. We saw the tip of the iceberg in the Q1 reporting by large banks. I have a feeling that Q2 credit losses will be much larger. Here's an example of what our work product looks like at the conclusion of a fair market value loan analysis. These two examples are loans that have a 3-year maturity. One is rated BBB, the other BB. You can see that our calculation of the expected credit loss follows the guidance in recording a loss contingency found in ASC 450-20. The key is generating the synthetic credit rating using the 4 main variables and applying the other company-specific factors relating to loan covenants, competitive strength, and enterprise value. Our work product is transparent and has a well-defined audit trail. So in summary, what do we have demonstrated is that there's a real need for a tool that can assist in assessing portfolio risk and potential credit loss, especially in the current environment. Our platform, using 4 key variables, generates an estimate of fair value for either a single loan or a loan pool. It's transparent, it's been vetted by independent parties, and has been tested against actual transactions. That concludes our presentation for now. Thanks for listening, everybody. We're now going to open it up for questions.
Right, so if you have a question, feel free to type it in. We have a couple. I know that we're running a little over on time, so we'll try and get to just a couple really quickly. The first question is, why is there a disconnect between the stock market and declining GDP? Either Stan or John, you can answer that. Try and answer that.
John, you want to take a shot at it, or you want?
Go ahead, Stan. Why don't you take over?
All right, fine, sure. I think the stock market is, again, this tremendous amount of liquidity being generated by the Fed. And a lot of this liquidity is going towards the purchase of, in the case of going to the purchase of stock, but in the fixed income markets, there's a lot of junk bonds that are being issued and being purchased, so spreads are narrowing. So prices of junk or lower rated securities are rising along with equity. The expectation, of course, implied expectation is that this will be a very, very short-lived decline. That in fact that the second quarter will likely be down, but by the third quarter the economy will be revving up again and starting to get back to normal. It turns out that once the earnings start to come in, I mean, some of the big firms obviously have reported earnings. Second quarter earnings are going to be far different. And in fact, if you take a company like Google, for an example, which is way up, their guidance is, in fact, they don't have any guidance or very little guidance for the second and third quarters of this year. They get most of their money, or a large portion, certainly of their profits, through searches and advertising and the advertising that follows these searches. The airlines, of course, are going to be reporting, horrible numbers. Retailers are already, some of which, like Neiman Marcus, for example, if they haven't been, they're probably going to enter Chapter 11, and there are going to be other firms that are like this. This is the equivalent of a rally in what I would call a bear market in both the credit markets and the stock market. So, in summary, it's just, I don't think people are measuring the economic fallout that closing the economy for the period of time that's been closed is going to cause. and how and people don't get back to what I'll call normal business in a rapid pace. There's a great deal of uncertainty. Also, there's supply chain issues. There are a number of issues. I just don't think the markets is fully reflecting all that.
And we have a quick follow-up to that. How much of the projected future recession and decline was priced into the market in March pre-stimulus?
Well, I think again, pre-stimulus is the once the pandemic became really on our radar screen, and you could see what happened when the Fed didn't have a stimulus program. Not the Fed, when the federal government didn't have a stimulus program, the Fed wasn't prepared to step into the credit markets. The markets crashed. I mean, that's what happens. The fact that they're doing an unbelievable, I mean, their stimulus program in terms of the numbers of dollars, even it's almost unimaginable, actually. If you actually asked an economist 6 months ago whether we would ever be at this point. I just don't think the markets have fully digested all of this. This is a new experience. This is the equivalent, it seems to me, of the oil price shock that occurred in 73, 74, when people had no experience with how the quadrupling of oil prices would make much of the economic, most of the capital stock of American corporations completely non-economic. So we're in uncharted waters here. And while it's true that the government is going to make things somewhat easier, the stimulus is going to take a while to create the kind of support that the markets anticipate.
Okay, thanks, Dan. So we are running out of time. We have a couple more questions, but we'll answer those offline. We'd like to thank everyone for attending this webinar. And as I said, we'll send out in your email links to both the PowerPoint presentation and also the link to the webinar. So thanks again and have a good afternoon.